When most people read an income statement, they treat the top line, reported revenue, as an absolute law of physics. They assume that if a company reports $100 million in sales, $100 million actually changed hands. But under accrual accounting, revenue is a man-made construct. It is built on management discretion, subjective estimates, and highly flexible cutoff dates. When the underlying economics of a business begin to falter, aggressive management teams exploit this flexibility. They prioritize the appearance of quarterly growth over the actual generation of cash. This brings us to the first major category of financial deception, identified by forensic accountants as earnings manipulation shenanigan number 1, recording revenue too soon. The core mechanic of this trick relies on a simple temporal shift. Management takes future, unearned revenues and pulls them into the current financial period to hit Wall Street targets. Doing this creates a mathematically unsustainable cycle. By stealing sales from tomorrow to inflate today, a company guarantees future shortfalls, ultimately destroying long-term shareholder value. Because every manipulated dollar on the income statement must double enter elsewhere in the ledger, pulling the future into the present always leaves a detectable footprint. You just have to look at the balance sheet and the cash flow statement to find it. The most primitive method of revenue acceleration involves physically holding the accounting books open past the end of the quarter to capture the next month's sales. Consider the software giant Computer Associates. They relied on selling massive multi-year software licenses for enterprise mainframe systems. Internally, the company instituted a practice of 35-day months. Executives regularly backdated contracts signed in the new quarter so they would appear as revenue in the previous one. The motive for this fraud traced back to their 1995 Key Employee Stock Ownership Plan. This plan guaranteed a massive payout to top management if the company's stock price stayed above a specific threshold for 30 consecutive days. Executives like Chief Operating Officer Sanjay Kumar engineered this calendar manipulation specifically to secure that target stock price. Once the inflated revenue numbers pushed the stock price over the threshold, the top 3 executives split a combined bonus payout of $1.1 billion. This temporal trickery had an immediate structural consequence on their financial reporting. Because the cash for these newly recorded sales wasn't actually due from clients yet, Computer Associates' balance sheet showed a massive surge in long-term, unbilled receivables. Bypassing the calendar does not create new business. It mathematically starves the subsequent quarter of its legitimate sales, forcing management to stretch the next quarter even further just to survive. Management can also accelerate revenue without altering the calendar by manipulating how they account for multi-year contracts. We see this clearly in the case of software maker Transaction Systems Architects. To hit revenue targets, the company changed its internal policy to recognize the entirety of a 5-year software license upfront, rather than spreading that revenue over the life of the contract. This type of front-loading is often achieved through a complex accounting mechanism known as percentage of completion accounting. The percentage of completion formula calculates revenue by dividing the costs incurred today by the total estimated costs. But total estimated costs is a subjective management estimate. If management artificially shrinks that denominator, the percentage of revenue recognized automatically increases. By artificially lowering the estimated costs to complete a project, management forces the current period to absorb an unwarranted chunk of the contract's total revenue. This calculation forces the company to record revenue far in excess of the actual work completed or the actual value delivered to the client at that time. Whenever management relies on highly subjective estimates to front-load contract value, they sever the connection between recognized revenue and the actual economic value delivered. Front-loaded revenue leaves a glaring trail in the financial statements. Accounting rules can dictate when a sale is recorded, but they cannot fabricate actual cash in the bank. The first major red flag investors should look for is cash flow from operations beginning to materially lag behind reported net income. You also have to check the balance sheet for unbilled receivables. These are assets created during the production period before a customer is even legally responsible to pay, which stands in stark contrast to standard billed receivables, where an invoice has actually been sent. At Transaction Systems Architects, sales grew 22%, but unbilled receivables skyrocketed 65%. We detect this using days sales outstanding, ending receivables divided by revenue times days in the period. Applying this, their collection time jumps from 32 to 52 days. A 20-day spike in unbilled days sales outstanding is a catastrophic warning sign for investors. It means the company is aggressively recording sales on paper long before it expects to see a single dollar. When unbilled receivables and days sales outstanding grow significantly faster than total revenue, it mathematically proves management is booking sales before the cash collection cycle can support them. Revenue manipulation also extends to the physical shipment of goods, starting with bill and hold agreements initiated by the seller. Under Chief Executive Al Dunlap, Sunbeam offered massive discounts to retailers to purchase seasonal items like grills 6 months early. Sunbeam recorded the sales, but kept the physical inventory sitting in third-party warehouses. Booking these $35 million in phantom sales was a pure accounting fiction. The buyers had not accepted delivery of the goods, nor had they taken on the risk of ownership. A second trick manipulates the customer definition, using sell-in versus sell-through accounting. Under conservative sell-through, revenue is recorded only when the product reaches the end user. But in 2004, McData aggressively shifted to sell-in, recording revenue the moment product hit the distributor. This shift left a clear footprint on McData's financials. Despite entirely flat sales growth that quarter, their days sales outstanding inexplicably jumped from 50 to 60 days. Shifting to a sell-in policy without altering the underlying physical business model is a camouflage tactic. It is deployed almost exclusively to hide deteriorating end-user demand. The core fatal flaw of accelerating revenue is that it acts like a treadmill that continuously speeds up. A company must execute increasingly larger accounting distortions each quarter just to cover up the gaps created by the previous period's acceleration. While management can temporarily dictate the shape of the income statement, the resulting strain cannot be hidden from the cash flow statement and the balance sheet. To catch this, continuously monitor the spread between cash flow from operations and reported net income. A widening gap here reveals paper profits lacking actual cash. Next, aggressively track days sales outstanding. Watch specifically for unbilled and long-term receivables that are outpacing top-line revenue growth. Finally, heavily scrutinize footnote disclosures for sudden shifts in revenue recognition policies, such as a highly convenient move from a sell-through to a sell-in reporting model. Financial statements only reflect the truth when the accounting methodologies align with the physical economics of the business. When the accounting diverges from the physical reality, the numbers are no longer a report of corporate health. They become a map of dissection.